Hey, how's everyone doing? My name is MacBrennan Peet. I wanted to start off with like a, everyone tells you not to start off with like a question to the audience, but I'm going to do that. How many people like use DeFi? I'm just actually genuinely interested. Like, okay, so we got 4 people that use DeFi. Okay, so out of those 4 people that use DeFi, do you just use like, is there just one venue that you like? If you use Camino, do you just use Camino, or do you also use like Drift? Is there anyone that just uses one DeFi venue? Okay, which DeFi venue? Camino. Okay, that's very interesting. But for the rest of the 3 people, multiple venues, right? You're trying different things, basically. Okay, cool. So this is not for you. No, I'm joking. So Project Zero is sort of like this new financial primitive that we launched 2 days ago. So it's very fresh. It's basically a DeFi-native prime broker. So this is not something you've probably used in DeFi before. This doesn't exist. So what that means is, here's some venues on Solana. You might recognize Hyperliquid and Aave. That's not on Solana, on different chains. But all these venues, you do different things, right? So use Camino. Camino's a borrow lend. Camino's a great borrow lend. Hyperliquid is known for like their fantastic perps. Jupiter does a ton of stuff. Drift is like a exchange on Solana. And what happens is, if you're a DeFi user like me, and I think like most people, so out of like the four people here, 75% use multiple venues. You use multiple venues. But the problem is when you use multiple venues, if you have $100 on Camino, $100 on Drift, $100 on Hyperliquid, you have to go to each to borrow against each position, right? Like you actually have a $300 portfolio. But if you want to get like $90 of credit, you got to pick, okay, maybe I'm going to go to Hyperliquid and borrow against my $100 position. Project Zero fixes that. So Project Zero essentially says, hey, you have a position on these 3 venues, these 4 venues, these 5 venues, these 10 venues. You can now borrow against your whole on-chain portfolio. So kind of like a massive unlock. So this exists in traditional finance, a prime broker, but they kind of just serve like hedge funds and trading desks, and in the traditional finance sense, it's more like you got money on the NYSE, the Nasdaq, the Hong Kong exchange, the Shanghai exchange, etc., and you have this capital fragmentation. But now in DeFi, that's starting to emerge. We have like these established DeFi primitives. And DeFi is multi-use, right? You can't trade perps on a borrow lend, and you can't do swaps on a lending venue. And if you want to use a stable coin, that might be another venue. And if you want to do a launchpad, that might be another venue, etc. And so you run into this capital fragmentation. So to break this down a little bit more, I'll start with like a simple use case. So a lot of people like really high yields in DeFi, and they kind of chase these yields because from like a risk adjustment perspective, DeFi venues typically have to offer a higher yield to attract your capital. And so when you're yield farming, you typically, again, don't just use one venue, you're hopping across different venues. So now you can hop across a bunch of different venues. And then if a new trading opportunity pops up, you can borrow against your capital on all these venues. So again, just to make that clear, if you have like $100 on Jupiter, $100 on Drift, $100 on Camino, new token just drops, you can borrow against $300 in one click on Project Zero. And you can manage all of this in one click through Project Zero. So that's a simple use case. I'll get to like a more complex use case. So Project Zero is starting with like lending markets, but it will soon integrate swapping venues and perp venues. And so what that means is now let's say a easy, more complicated example is, let's say you want to set up a delta neutral position between 2 perp venues. So I want to go long sol perp on Drift, and I want to go short sol perp on Hyperliquid. I want to do it at the same price. So I go $100 long on Drift, $100 short on Hyperliquid, both at like $200 strike price, for example. You're delta neutral, right? But Drift doesn't know you have money on Hyperliquid, and Hyperliquid doesn't know you have money on Drift. So now if you're long Drift, short Hyperliquid, and the market goes up, you get liquidated on Hyperliquid. And that sucks, right? And this matters a lot because maybe there's rate divergences between Drift and Hyperliquid. Maybe there's price divergences. There's a lot of reasons to be set up multi-venue. And this is like, again, a very basic example. Through Project Zero, you're not liquidated because Project Zero, you're delta neutral. You're trading Drift and Hyperliquid through one unified credit and risk engine. We recognize your holistic portfolio. You're not liquidated. In fact, we make it easy to sort of like rebalance margin to the venue that you need to potentially like cover your decreasing health with the increase in the venue where your account value went up. So that's a like more complex example with perps. But you can start to see where this is going. So like if you're a sophisticated trader, you might be running cash and carry trades that involves like spot and derivative trades. Yeah, you might be, you're probably using multiple lending venues. Just to double down on Camino, Camino has different markets, and if you have your money in one market, you can't use that in another market. This solves all these things. So capital fragmentation is starting to become like a really big problem in DeFi because now we're at the point where it's maturing. There's billions and billions of dollars here. There's hundreds of billions of dollars being transacted per day. There's really cool stuff happening that is kind of unique to DeFi at this point. Perps is a good example. Another example is sort of like these proprietary AMMs that are happening on Solana where you can get like really tight spreads on like Solana USD, tighter than you can even get on like Binance or Coinbase, for example, and inclusive of like lower fees essentially. So there's these cool things happening. DeFi is maturing. People are like used to the venues they like using, but the minute they use more than one venue, their capital gets fragmented. So this is sort of just like a visual example of instead of seeing like your miniature, your mini account health on Drift and Camino and like managing that independently, you can just do that on one venue now. And both are considered together. So the cool thing about Project Zero is it's live now. The credit and risk engine is built on Solana. Our first market is live, which is the Project Zero market. That's where like the credit comes from. And Camino actually is going live on October 8th. So that'll be like our second venue. And we'll quickly go live with Drift and Save after. And Jupiter Lend just launched. There's been a ton of liquidity there. So we'll integrate them as well. But the cool thing is as I've mentioned like Hyperliquid and Aave. And this is not sort of just contained to a single chain. So there's like a really cool unlock here is we built the risk and credit engine on Solana because Solana's, has extremely fast speed. It's extremely stress tested at this point. There's a lot happening on Solana. Like most trading activity across blockchains happens on Solana today. That's just sort of like a irrefutable fact. But we can collateralize positions anywhere. We can do this actually better than like bridging protocols, with a different approach than bridging protocols. So if you're used to like moving money between Solana and Hyperliquid, for example, you have to go through a bridge, right? You got to go, or you go through like some sort of market maker that's like quoting both sides essentially. And that's great. That works super well. But you actually like don't even need to move capital anymore. Like let's say, for example, you have $100 long on Hyperliquid ETH perp. And then something comes up on Drift and you want to collateralize that Hyperliquid position to go trade on Drift. So before, what would you have to do? You'd have to withdraw that from Hyperliquid. You'd have to move that through a chain. You'd have to set up your account on Drift. You have to go long or short, whatever you're going to do. You just paid a bunch of fees. You just waited a long time. It's, a headache. If anyone's used bridging, I think Layer 0 does a really good job, but it's still kind of like a headache. With Project Zero, you went long $100 ETH on Hyperliquid through Project Zero. So we already see your account. Let's say that trading opportunity happens on Drift. You can just collateralize that position and trade on Drift, and actually no money has even moved cross-chain because the credit engine sits on Solana. So that margin is coming from our global pool. Our global pool, which by the way, already has $225 million in it. and $95 million borrowed as of yesterday. So so you got some capital to play with, right? And now you just don't even need a bridge anymore. Now you got this like cross-chain unified portfolio with all the like really important stuff built on Solana, which is super cool. So yeah, there's a, I'll explain like, I don't know, in case anyone's super interested, there's a lot of like really cool market making stuff happening on Solana right now. And market making is inherently multi-venue. You can't just, if you're quoting, for example, like Solana USD, you can't just like try to give the best prices on Solana USD on your particular order book and not care about what other order books are offering. If other order books are giving a tighter spread than your spread, they're going to get your flow, right? And so market making is like inherently antagonistic. You need to, at the same time as like having the tightest spread to your desired flow, you need to widen out the spread of your competitors, essentially. And you need to, we call this like picking them off, essentially. And so what happens is you have money on multiple venues when you're doing this. And if anyone's used AMMs or order books, you know you can't borrow at all against these positions. There is no borrowing. Like if you use like, you know, well-written order book is called like Phoenix Exchange on Solana, or there's, you know, AMMs like Radium and Orca, etc. Yeah, if you've used any of them, you can't borrow. Now, however, you know, if you have money set up on, if you're quoting, maybe you have like a yielding resting order on Drift, for example, and you're quoting on Radium, you can collateralize your Drift and to quote on Radium. I'm saying the same things over and over again, and it's just essentially like giving you different examples to try and like show you the extent of the unlock this is. But I'm using market making as an example in particular because a lot of really cool market making stuff is happening on Solana right now. Again, in particular with like prop AMMs. So this is just like a, you know, esoteric visual, like showing, oh, if I'm moving between venues, I can do that capital efficiently now. If you're an algorithmic trader, not just if you're like a, you know, passive retail participant using a UI, you can now plug into a single SDK across all the venues you love. It's like a much better developer experience, and move across markets with like unified liquidity, which is super cool. Unified margin and unified risk. The one other thing I wanted to say here with this visual, this esoteric visual, is because we get a better view of your entire portfolio, we can actually give you better risk and better rates. What do I mean by that? Is let's say you have, you know, a position on venue A and a position on venue B, and these are offsetting positions, meaning that they sort of like cancel out your exposure. However, if you like zoom in on venue A, maybe you're like super long, and if you zoom on venue B, maybe you're super short. So venue A is going to restrict your borrowing against that super long position, because if the market moves down, you're going to be liquidated really fast. And the same thing inversely on venue B. However, so like your loan to value ratio, for example, is maybe going to be like 50%. However, if from a holistic portfolio perspective, if we see that these are offsetting positions, maybe we can give you an 80% LTV, because if the market moves up or down, you're not going to be liquidated. So we can actually give you like better risk parameters, and like adjacent to that, we can then give you better rates as well, because maybe that's now viewed as a less risky position, and so we can sort of give you a more advantageous rate on that. We see this as like healthy utilization instead of like unhealthy utilization. So now you're getting better risk, now you're getting better rates, you're getting better UX, because you're doing this from like one SDK or one screen. You're getting better capital efficiency. I've hammered that point home. And the final thing is we're not adding additional excess smart contract risk. So the way we do this is we add a self-custodial account in between you and the venue you're using. So again, this is like an account owned by you. This is not an account we can do anything with. The only reason we're adding this additional account in between you and like the underlying venue is so that we can liquidate you if your account becomes unhealthy and protect solvency of the credit engine. So there is no like net new risk from like a smart contract side that you're actually adding by doing this, which is also like a very elegant solution. So that's also pretty cool. So it's like it's very easy to start plugging into this and using this. So yeah, those are like kind of the main things I wanted to hit on. This just came out. This came out on Thursday, and it was pretty well received. And I was very happy with the launch actually. And yeah, our first venue is live, so you can, you know, over $200 million deposited, close to $100 million borrowed, so actually pretty capital efficient right off the bat. And the minute we're going to add our second venue, Camino, on October 8th. Early November, we expect Drift and Save to go live. And then our sites are set on Jupiter Lend and Loopscale, and then we'll have 100% coverage of lending venues on Solana. And we really want to do that by like end of year, ASAP. Drift and Save are already in audit right now. Camino has been audited and has been reviewed, and it's just essentially rolling out. And then the cool thing is after that, we're going to tokenize, and we're going to tokenize before our biggest integrations, which we view as perp markets. So think Hyperliquid perps, think Drift perps, think Jupiter perps, and the minute you add perp markets as cross-margined assets against like full lending market coverage, you can do really, really, really cool things with your portfolio, and you don't keep running into the problem of having to move like money around and run into this constant capital efficiency headache and management headache. So that's like the immediate timeline, and I'm very excited about that as well. And you know, we'll probably add some swapping venues as well. We'd love to, you know, add a bunch of AMMs because you can't borrow at all against your AMM position. So if anyone's using that, we're just cognizant of like sort of like how much flow prop AMMs have captured recently. So we're being pretty reactive to that. But yeah, starting with lending market coverage. So if you're using lending markets on Solana, we're looking to make your experience 10x better, and then we'll add perps after we do that. So yeah, that's Project Zero. If anyone has questions, I'm happy to answer any questions. Yeah.
So first of all, congratulations on the launch.
Thanks.
This is fascinating. Is this the first product of its kind? And what inspired you to make this? Do you have a solution? Like, is this a problem you had, or?
Yeah. So, yeah, this is sort of like a landmark moment for Solana DeFi. This doesn't exist. So if you asked me like who are my competitors, I'd be like, I have no idea, which is cool because like, you know, it's hard to innovate in finance. And you know, this exists in tradition. I'm not. This is not like some eureka moment, but yes, like anyone who's using. So from our 90%, that's wrong. 99% of DeFi users use multiple venues. There's very few DeFi users that just use one venue. And the minute you use more than one venue, this gives you a better experience. If you just use one venue, this actually can't give you a better experience. But the minute you use more than one venue, this gives you a more capital efficient experience over your DeFi activity. And so given that 99% of DeFi users use more than one venue, this is a natural addition to their stack. And it's really cool because it's multiplicative to any venue we integrate. You know, now that venue gets new liquidity flows, it's very easy to sort of like compress rates across these new venues to their risk-adjusted yield because arbitrage becomes much more capital efficient between them. So it makes everything much more efficient as well. But yeah, to answer your question, yeah, this is the first time this has happened. I think anywhere in DeFi. Yeah. Oh, there is no token live. We plan to tokenize before our biggest integration, which is perp markets, and we plan to do that by end of year. But right now it's just we're just a product that is trying to solve problems and make sure that we're solving those problems before doing any sort of tokenization. Yeah. Yeah.
Thank you. Oh, give one more.
Oh, yeah. Go ahead.
I want to say congratulations on the launch. And do you guys plan on integrating with the base ecosystem anytime soon? Because I know I have like a few DeFi position on VFAT and Aerodrome. So
Yeah. Yeah. We're going to go in order of user demand. So in order of user demand right now is a bunch of Solana venues because that's where just most trading activity is happening right now. And then the first venue non-Solana that we have demand for right now is Hyperliquid for obvious reasons. And Aave is, biggest DeFi protocol. There's a ton of capital there that would love to not have to be withdrawn from Aave, but be able to trade on Solana without having to be withdrawn, sort of using my previous example of just collateralizing that Aave position and going after trading opportunities on Solana. After we hit those, it's in order of user demand. So Aerodrome is definitely widely used base program, and we can absolutely integrate it. It's just essentially in order of priorities. And the other thing is, with each new venue, we need to do a very, very comprehensive risk check on the venue in terms of the assets we're enabling as collateral and sort of the leverage we're providing against them, the smart contract risk, et cetera, of each underlying venue. So it is a very dynamic process as well. But we can move super fast. Yeah.
Awesome. Thank you so much. Thanks, MacBrennan.